Welcome to Accounting in Australia, Presentation 2. My name is Emily Keehn. Case 1. Correcting a balance sheet. Fine Wines Limited began business on the 1st of July 2015, producing and selling wine. 1 year later, the company's newly appointed accountant, A1 Beer, needs to produce a balance sheet for a meeting of company executives. Unfortunately, A1 is more skilled at winemaking than he is at accounting and has requested your advice. He shows you the following balance sheet he has prepared. Assume that the account balances A1 has used are correct. Prepare a correct balance sheet. Provide an explanation of the differences between your balance sheet and the one A1 prepared. Firstly, their totals do not match. The accounting equation states that assets should equal the liabilities plus the shareholders' equity. Now, this could be due to some simple accounting mistakes by allocating debits and credits to the wrong place, or it could be a sign of a much larger accounting problem. In my balance sheet, you can see that the assets are equal to the liability plus the shareholders' equity, this indicating that the debits and credits have been allocated properly. Some of the things that have been recorded correctly are the cash and the inventory of grapes. These are both assets as they are bringing money in to help the business grow. The share capital, which is the funds put forward by the shareholders, has also been recorded correctly. Net profit was recorded as an asset. While it is good to have a net profit, this often goes back to the shareholders and needs to be recorded under the shareholders' equity. Accounts payable was recorded as an asset, whereas this is all the payments that are going out that you're making, so therefore it is classed as a liability. Accounts receivables was recorded as a liability, whereas this is the money coming into the business, so obviously it is an asset as it is making you money. Kitchen equipment was recorded as a liability. This could be put down to the fact that you're having to put out a large sum of money to buy the equipment, whereas it is actually classified as an asset as it can be used for a number of years and it has helped building and growing your business. Case 2. Your old school friend has joined the maintenance group of a large airline. He asks you the following question. Our customers pay us large amounts of cash, but we call this a liability. Surely it has to increase profits. How would you answer? Firstly, liability is defined as the economic obligation, debts payable to an individual or an organisation outside the business. Cash can be considered a liability if it is in abundance. This could also be a sign that the company has run out of investment opportunities, and sitting on cash can be an expensive luxury because it has an opportunity cost, which amounts to the difference between the interest earned on holding cash and the price paid for having the cash measured by the company's cost of capital. Case 3. Respond in point form to the following complaint by a businessman. I find modern financial accounting really annoying. The basis of financial strength is the availability and use of real resources, such as cash and machinery, yet accrual accounting produces a profit measure that is deliberately different from the cash return earned by the business. Why is this so? Why should accrual accounting diverge from the measurement of cash flow? Firstly, accrual accounting is defined by the accounting that recognizes records, the impact of a business event as it occurs, regardless of whether the transaction affects cash. It measures the financial effect of events by reference to when debits are created rather than when cash is paid or received. On the other hand, cash accounting is defined as businesses that use cash basis accounting recognize income and expenses only when money changes hands. They do not count sent invoices as income or bills as expenses until they have been settled. Some pros and cons of both accounting systems. So the cash accounting is a simple system that keeps track of your business cash flow, generally suited to a smaller business that mostly handles transactions in cash, for example, a hairdresser or grocery store. It gives you a picture of how much money you have in your till and in your bank accounts. It doesn't capture money that is owed to you or money that you owe to others. Accrual accounting is more complicated than cash accounting, better suited to businesses that don't get paid straight away. For example, architects often provide service that they invoice at a later date. A system that tracks your true financial position as it captures money that is owed to you and money that you owe to others, and is also helpful if you're dealing with lots of contracts or large amounts of money. There's a list of all my references used. Thank you for watching.